Okay, I believe we are live. Let me send the link out to everybody. Okay, I think. Okay, send now. So let's see. We'll get the notification. Okay, cool. Yeah, notification's gone out.
Yeah.
And okay. Yeah, we are live, and I think this members have seen the link. Okay. All right, guys. We're gonna wait for a few people to join. Okay, so yeah, random things is here. Okay, so elite members, when you've joined us, just give us a little hi in the chat so we know you are here and ready to rock and roll. Give it about a couple of minutes, and we are live. So, if you can hear me, guys, let me know in the chat, and then we'll give Kay a chance to audio check, mic check, and then we will crack on. So yeah, people calling you the GOAT already in, straight in there.
Not quite.
Straight in there. But guys, can you hear me in the chat? Can you hear me in the chat? Let me know whether you can hear me and whether you can see me. If the audio is okay, sound is perfect, loud and clear. Perfect. Okay, if you do a little audio check.
Yeah. Welcome, guys. Hope you're having a good evening. I should be watching Manchester United, but I thought I'd take this opportunity to. I look Afghan, not quite. I'm close. I'm Indian.
That's Musa. So Navid, that's M, right?
That's Musa. Nice Musa. I have a lot to live up to.
So yeah. So Bav said we can hear you both, which is perfect. Okay, cool. So we are good from an audio point of view and from a video point of view. Good. Okay, so elite members, thank you for joining. Thank you for taking the time out to come and learn something new. I'm excited about this. ETFs is something Mr. Bogle has been speaking about for Jack Bogle, by the way, spoken about, is a massive advocate for ETFs. Even Warren Buffett has said many times that he reckons 99% of investors should be invested in ETFs. So it's quite a great safe investing strategy. And of course, we are blessed today with the indubitably, is that how you pronounce it? It's such a tongue twister. Indubitably, Kay has decided to, he's happy to teach us and give us an introduction into the world of ETFs, and has kindly made an awesome presentation. I've been through it, so I'm excited for him to go through. But before we crack on, it would be rude of me not to give our guest an opportunity to introduce himself. So, bro, we know we really appreciate everything you're doing in the Discord, with the time and effort you put into replying to a lot of elite members. So we thank you for that. But this is your stage, bro. Give you about a couple of minutes. Tell us about yourself, how you got into investing, what you do, and yeah, then we'll crack on.
Perfect. So yeah, I'm Kay, or Kyalimer, however you want to say it. As many of you know, I'm a doctor or a trainee surgeon. I live in the northwest of the UK. I spend a lot of my time at work, essentially. But my investment journey began when I was in university, essentially, probably, I'd say 6 years ago now, maybe 7 years ago. Small amounts, maybe £100 here and there every month. And I know a lot of people in the GWB Discord are doing this at the moment, using their student loans and whatever part-time job they can get, and using it for investment. And it's amazing the growth that you can get if you're patient in your approach with this. And I've built up multiple 5-figure portfolios from that, and a few of them have reached 6 figures as well.
Nice.
So I'm very lucky and blessed that you have started from nothing and have come all the way. My aim today is to share some of my beliefs, some of my strategies. I think a lot of you know I do value investing predominantly, but I do dabble in growth investing and hyper growth stocks as well. A big believer in Jack Bogle, a big believer in a big believer also in Benjamin Graham and Warren Buffett. And these people have proven that these strategies work over a long period of time. And I think that's the key for young people like myself. I'm only 28. I know that we've got a lot of young people in the GWB Discord, and I think that's the key. Look at the 10 or maybe even 20-year timeline. Get rich when you need to be rich, and don't think about these short-term gains. There's no need to try and win the lottery tomorrow, in my opinion.
Nice. Nice. Bro, I was going to ask you, okay, so you're a fan of Jack Bogle and you're a fan of Benjamin Graham. Like, how is that even possible? You know what I mean? They're like opposites, because obviously Benjamin Graham is great for value investing and, stock picking, whereas Jack Bogle swears by ETFs. And like you correctly said, both of them have proven that either strategy works. So how will you, because I've tried to read a few books from Jack Bogle and I can't get through the first few chapters, and I put the book down. I'm like, nah, this is not for me. But then I pick up a book from Warren Buffett or Peter Lynch, and I'm absorbed, because I'm like, they're speaking my lingo. How are you able to fuse both?
They're not very different, actually. We'll cover some of that today.
Nice.
Benjamin Graham, for a fact, says that part of value investing, part of defensive investing, is that you can invest in ETFs. And like I said, we'll touch upon that today. Jack Bogle, for those who don't know, is basically the creator of Vanguard, which you could say is probably the biggest fund company in the world. It holds hundreds of billions in investments across its diverse portfolios. And he actually didn't start with much money either. But we'll talk a little bit about the history of ETFs today. And they're a very novel and new technique into your investment strategy. And when I say that, I say they're only about 20 years old. Whereas Warren Buffett, etc., have been investing for 50, 60 years. But even Buffett, if you look at some of his lectures that he's given, has said that for most people in our position, ETFs are a really good strategy and tool to have in the portfolio.
Oh, nice. I won't ask too many questions. Of course, there's some juicy stuff in the presentation coming right up. But before we dive into it, brother, I just want to let the elite members know, guys, if you have any questions, essentially we want this to be as interactive as possible. And what we're going to go through a couple of slides. If you make a note of your questions, and then we will pause through the presentation to give elite members an opportunity to ask the questions before we move on. So bro, you can see the comments as well, right? In the chats, you can see. Cool. Yeah. All right. So I'm going to hand over to you, brother. You can take it away, and it's all yours.
Perfect. Today we're going to be talking about exchange traded funds, or ETFs for short. I want to touch about mutual funds and some of the other types of investment strategies that have been derived from ETFs in the recent past. We're going to start off by having a disclaimer. Obviously, I'm not a financial advisor, so any of the content that we do talk about today is for educational purposes only, and I'm not suggesting that anyone should base their personal investments on the advice or information that I declare today. The second thing to mention is that the use of funds, in my opinion, can form at least some part of anyone's investment portfolio. That's not to say that you need to have 100% of your investments in funds, but I do think that you can form strategies around different funds. And we'll talk a little bit about that today. And at the end, we're going to go through some of the funds and how to research them. And I think it will open eyes for a lot of people who are simply in growth stocks, or those who are buying blue chip companies by themselves, the Apples, the Facebooks, the Googles, etc. Can you get tax-free ETFs? Suleiman is asking. It depends where you live, Suleiman. So essentially, you can buy your ETFs in the UK in an ISA, and that will make essentially a tax-free ETF purchase. If you're not in the UK, I'm sorry, I don't know the answer to that question. So what we're going to talk about today. So we're going to talk about what ETFs are, brief history about them. We're going to compare ETFs to mutual funds. And then we're going to talk about different types of ETFs. So active ETFs, passive ETFs. We've got our defensive portfolio strategy. And I'm going to go through Benjamin Graham's portfolio strategy for that. We're going to talk about a little bit of difference between accumulation and distribution for the ETFs. And we're going to then at the end go through some of my top picks and how to look at the ETFs when you're researching them, because they're obviously a bit different to when you look at a stock, which Emmanuel has gone through recently. I thought those videos were excellent, Emmanuel.
I appreciate it, brother. Appreciate
it. So ETFs, exchange traded funds, they are basically a security that track something. So that something could be an asset, a commodity, an index. So what do we mean by an index? We mean something like FTSE 100, FTSE 250, the NASDAQ, or the S&P 500. And it's exchange traded, which means that you can buy and sell this on the stock exchange. Just like a stock, you can buy it and sell it the same day if you wanted. The easy way to think of them is like a basket of sweets. So if you've got a nice basket of sweets and you want a little bit of each sweet, but you don't want to have to eat all of them, then what's the best way of doing it? And we're going to talk about the benefits of ETFs a little bit later, but if you try to buy each sweet individually, it's going to cost you a lot of money, and you may not have that amount of money to be able to buy buy each sweet. But secondly, buying sweets is going to cost you commission, or buying stocks is going to cost you commission in this case. And if you have to pay commission on each individual stock or sweet that you're accruing, then that's a lot of money you're giving away for absolutely no reason. So instead, you can buy one basket or a portion of the basket and pay commission only once. Then you are saving a hell of a lot of money over a vast period of time just from commission. But we will talk about some of the other benefits as well of ETFs. ETFs have become really successful in recent history, and one of the reasons for that is because almost anyone can access them. I'm going to talk about what ETFs are available in the UK predominantly in this presentation today, and I'm sure there will be some ARK fans who hate upon me for this, but we will talk about ARK as well, so I'm not going to leave out all the ARK fans today.
Easy.
So history. So actually, we didn't have ETFs first. We had mutual funds, and they were created in 1990. So like I said, only about 20, 30-year history for these types of investments existing. And the first one, which is probably still one of the most popular and best ones, is the S&P 500 tracking index. And that was a mutual fund to begin with, and that started trading on the American exchange in 1993. Subsequently, we had other tracker funds launching. Hong Kong was one of the most popular ones to launch next, and that was in 1999. And that was a true ETF that launched in Asia. And then it became more popular in Europe through the early 2000s. And we had BlackRock launching their first UK-based ETF in middle to late 2000. ETFs have literally proliferated since we've gone from having a handful of ETFs to thousands, absolutely tons of them. And I'll show you different ways of searching ETFs today. For those of you who don't know how to find an ETF that you like, and we'll go through that at the end of the presentation. Some of the benefits of ETFs, again, you can categorize your ETF. So at the top of this slide, we've got index ETFs that we've mentioned, and they were the first ones to come into the market. But since then, we've now got ETFs tracking fixed income or bonds, essentially, commodities. So you can have a gold tracking ETF. I think the best performing ETF in the last 5 years is actually rhodium tracking ETF, which is up between 3.5% and 5,000% in the past 5 years. And if you look at the price of rhodium, it is definitely up, but it's not as much as the ETF is. So there are some benefits to ETFs like that. And you can actually track currencies as well. So if you want to track, I don't know, the USD to GBP, and think that USD is going to go strong, then you can have an ETF based on that too. So, you've got so many options here with your ETFs.
Nice.
So, people get confused between mutual funds and ETFs, and I see a lot of people using the terms interchangeably, or people just cut it short and say, I've got a fund. So what are the differences? Predominantly, the main differences are that mutual funds tend to be actively managed, and we'll talk about active versus passive management a little bit later. And the second big difference between mutual funds and ETFs is that you can only buy and sell a mutual fund once per day. So there will be an opening and closing price for a mutual fund, which changes every 24 hours. And that will vary based on where the mutual fund is based. So US-based funds may close at 8 a.m. Eastern time for them, and UK-based funds may close at 6 p.m. GB time. There's a lot of similarities between funds, between the mutual funds and exchange-traded funds, and that's why they are interchangeably used. This particular slide shows that you've got higher tax implications for mutual funds. Now, this slide is actually for the US market. In the UK, mutual funds and ETFs are virtually treated identically. And the reason for that is because of UCITS classification. And once again, if anyone wants to know about that, we'll have a slide with a link available. Emmanuel, I think I'll send these slides out to you so we can pass them on to our elite members.
Nice.
At the end as well.
Thank you.
So I'll just pause there. I'll have a look and see if there's any questions. Doesn't look like it. Someone said shots fired. Pastor J is in there. Excellent.
I think the XP had a question. The XP asked, he said, why are you so damn pretty?
Yeah, well, I don't know if that's a question or a statement, but I appreciate it, XP. I do. Thank you.
Musa is appreciating the table of contents.
Musa, you're my inspiration. You're my inspiration. Absolutely.
XP says your presentations are always on point. Of course, lumber ETF, it is. That's from Teddy.
Excellent.
On point. Yeah, I mean, bro, you've done what, 2 slides and everyone's loving it so far.
I know.
So, bro, let's go.
That's good.
Let's go.
So, right. So we'll talk some more pros and cons of the exchange traded funds now. So we've discussed that you're going to have low commission costs with this. So, for example, I'm in a Vanguard fund. It charges 0.22% commission. It's absolutely nothing. Whereas if you try and buy something on Trading 212, your fees automatically are going to add up to at least 2 to 2.5%, maybe 3% if you're buying a US equity. So your benefit of the ETF is already there 2.5%. You've saved 2.5% money instantly. And you can double that because when you sell your ETF, you're going to get charged nothing. Whereas if you sell your equity from the US, you trading 212 or DeGiro, they're all going to charge you again your 0.5% or whatever it is for your exchange fee. Some more pros. So the intraday liquidity. Now this is really important for those of us who may want to day trade ETFs. And I know a couple of people that I've been in contact with have been swing trading and day trading the INRG, or the iShares Global Clean Energy Fund, over the past few weeks and months, and that really has had a big up and down. But we'll be talking about that a little bit later as well. One thing I would say is that the purpose of your ETF investment is not to chase alpha, and alpha is essentially gains, so profit. I know Ali's talked a little bit about alpha and beta in the GWB Discord before. So for those who don't know, alpha is your profit making and beta is your volatility. So you want your beta as close to 1 as possible, because it means that there's not much volatility. Those of you who are in crypto, for example, will be having extremely high betas. But there's pros and cons of that as well. You can make a lot of money very quickly. You lose it just as quickly as well. So we talked about strategizing your investments. So I don't know, let's say Musa is a fan of Danish companies. So he might want to go and find Danish ETFs. And I'll be showing you guys a way of searching your ETFs a bit later. XP is a big fan of green energy. We all know that. He's a big fan of semiconductors as well. So you might want to go and find ETFs which are based on semiconductors, or like I've discussed, the iShares Global Clean Energy Fund, which focus predominantly on your clean and green energy companies. So, it's easy if you really want to have an ETF full of these types of companies. Someone recently showed me a hydrogen ETF as well. Has
that got Nikola in it? Has that got Nikola?
I don't think it does, the clever managers, they know not to get Nikola into these investments. So Moose is asking, how do you calculate beta? That's actually quite complicated, but to make it simple, you look at the what you're comparing the ETF to, or what you're comparing to your equity to. So if your equity is part of the S&P 500, you're going to look at how far it deviates. So it's the standard deviation, essentially, from the price of your comparison. So something like Apple is not very volatile because it doesn't move very much in comparison to how an S&P 500 moves. Whereas you've got something like Tesla, which you'll see that the beta will be significantly higher on, because it moves much more as compared to something like the S&P 500. Got next saying, so this is only for UK people, correct? As in you buy it and it's in pounds, so you don't pay the extra commission. Is it, however, the same for people using euros? So next, it is. Your extra commission is actually going to depend on the platform you buy it on. But depending on where you live, your exchange traded funds and mutual funds will be available directly through most companies. So if you go and sign up to Vanguard, you can pay zero commission and pay them in euros for their Vanguard ETFs. Same thing with BlackRock with their iShares, and all the companies, Morgan Stanley, for example, as well, if you're in the US. So it doesn't really matter where you are. It does matter about the currency, you're right, but that's going to be based on the exchange that you're using. You can avoid that completely. DeGiro, for example, has got a spreadsheet available where it has certain ETFs and mutual funds listed, and it charges zero commission on them, despite you buying them in a foreign currency. So it's worth looking into the benefits of what platform allows you to have what benefits. I know Hargreaves Lansdowne, for example, doesn't charge its £11.95 or whatever it is, a dealing fee when you buy ETFs and mutual funds regularly as well.
Nice.
So I hope that answers that question.
Can I ask a question, bro, just before we move on? So in terms of the commissions then, let's say someone's brand new to ETFs, are they paying commission for every time they invest in the ETF, or is that, when is the commission charged? Is it at the end or at the beginning? What point is commission taken?
So it will vary depending on the ETF or fund. Very few of them have a dealing charge. In fact, I've seen none that I am investing in that have a dealing charge. It tends to be an ongoing charge. So I mentioned 0.22%. That's an annual fee for my Vanguard fund. Some others have half yearly or even quarterly fees. They tend to be the actively managed funds. So if you do go for an active managed fund, and I've written it here on the slide, they do have slightly higher costs, and they don't always give greater gains. And I'll just click on that to show people. I hope they can see this. So this chart shows US large cap funds between 2005 and 14. So that's a 10-year period. And it's actually a predominantly bull period from 2009 onwards. And yet the actively managed funds, these are all active managed funds, by the way, you can see that most of them either are market equivalent or underperform the market. So, was there any point in going for the actively managed funds? Again, ARK lovers are going to start hating on me probably, but don't worry, I've got good news for ARK lovers coming a little bit later. Let's go back to the presentation. There we go. Something else to mention as well, the negative of the ETFs is that if you go for your really niche ETFs, they will have low liquidity and they will be more volatile, essentially similar to your small cap or medium cap stocks. So hopefully that clears some benefits up. So we mentioned active versus passive investing. So what's the difference? Well, active portfolios will have a fund manager who is trawling through all the companies in that fund, and they will be making constant changes, sometimes daily, sometimes weekly, sometimes quarterly. And that's what a lot of you see with your ARK investments. We've got a lovely GWB Discord channel for ARK, and you can see that they basically make investments daily. It's a very, very highly actively managed fund, and there's pros and cons to that. So we've kind of discussed earlier that not all active mutual fund managers will beat the benchmarks, and this is a study by Vanguard, which ended in 2018, I want to say. I've put the link up there, so I might be wrong. It might be a bit earlier than that. But you can see that over a 15-year period, only 18% of actively managed fund managers beat the benchmarks over that period. Wow. So, you may have excellent gains in your active funds for 1 year, 2 years, 3 years even. But over a longer period of time, it's very, very rare
That's crazy.
for people to beat the market. And the most famous example we all know is Peter Lynch for Magellan Investment Fund. He did it for so long. Warren Buffett's another one. If you consider that his company is basically just a big ETF.
Yeah.
Pretty much.
Yeah.
So is active investing wrong compared to passive investing based on those numbers? Well, not really. If you pick the right fund manager and you do your research, you look into what it is they believe in, and I am pointing at Cathie Wood fans here, then actually you have someone who could be one of those 18% who beat the benchmarks over a 15-year period. And if you do that consistently, and you don't put all your eggs in one basket with it, it can be a really good thing to have in your portfolio. I have previously had several active funds. Some have done okay, Some have done badly and some have done well. But recently I've removed all of my actively managed funds and have gone fully passive. And the simple reason for that is commission fees. So most active funds will charge between 3 to 5% per annum for being part of the active fund, whereas the example I keep going back to is Vanguard is 0.22, or some of their higher ones are 0.5%. And Vanguard also has semi-actively managed funds, which they look at every 6 to 12 months. So that's not a bad shout as well. They're the ones that cost you about 0.5%. So yeah, there's different products out there for different people.
So, okay, do you mind if I jump in? So, okay, that's insane. So, okay, I'm trying to how do I word this? So, in a year, right? Let's say the fund is maybe the active. We're talking about active now. Let's say the active fund returns what 5% on the year, on maybe underperforms the S&P, and then they charge that commission. So that pretty much wipes out everything it's gained that year.
Correct.
Okay, I can see why you started getting rid of some of that. Wow. Exactly. So obviously with the fee, I mean, okay, I know obviously last year ARK invested really well. So I'm not sure what their commissions are. But this year it's not looking great for ETFs. And then so if the company underperforms in the year, let's say they return negative, will they still charge commission on top of that negative performance?
That's right. So they're not charging you on your profit or loss. They're charging you on your whole investment. So if you put £10,000 in, you will be charged on the £10,000, not on your profit or losses.
So even if I end the year maybe down 9,000, I'll still get charged for that 10,000 initial.
Correct. Yeah.
Okay. Wow.
Yeah, eye-opening, isn't it? So
yeah, very. I did not know that.
There was a chart. I didn't put it in, but there's a very nice graph out there that shows that active investments have now just been overtaken by passive investments within the last 12 months. So it shows you how people are catching on to this, and how people are wanting to go for the passive investment strategy. It's relaxed, it's low fees, low cost. They don't need to do much work. You don't need to worry at all. And it gives you, in 80% of cases, the better amount of gains over a long period of time.
Over a long period of time. Because that's what to say. I mean, like Kathy Wood, you look at the results last year, you're blown away. But if this year carries on the way it is in terms of growth stocks getting hit, and obviously predominantly her ETF is full of growth, genomics, all of these EVs and all this stuff that are getting hit right now, they're going to underperform. Yeah, but she's talking about, they're looking at it over a 5-year span, whereby they believe they will beat the S&P on a compounded CAGR, essentially, over a 5-year period. So that's why she talked in many of her interviews. She talks about she's not looking for profits now. It's not about now. It's about 5 years down the line. In that time, you're still getting taxed fees, though.
Exactly,
and that's one thing that's not spoken about at all.
That's right. And it's the fees that will make the biggest difference. There's actually a fantastic question in the chat by Teddy that says, what would you say is the main benefit of going for an ETF versus an index? So if you can directly invest in an index, Teddy, then I would do that. But as a retail investor, you'll find it very difficult to directly invest into the index. You'll have to do it via an ETF. The benefit of directly investing into an index is that you don't have to pay the fees or commission to do so. So an ETF will charge you at least something. So even if it's Vanguard's S&P 500 USDA ETF, you're still getting charged about 0.25% on that. So if you want to save 0.25%, then you go directly for the index. But you need to have a vast amount of funds to be able to do that. I did miss a question earlier.
Suleiman.
Suleiman, that's right. Yeah, is an ETF managed by just one person or a group of people? So Suleiman, that depends on the group managing the fund. Most funds will have several people involved, but there'll be an overall fund manager. And it's the fund manager that normally gets hidden away, historically anyway. So people didn't know who Peter Lynch was for years and years, despite the Magellan Investment Trust absolutely smashing results year after year. And it was only after there was massive media pressure that they essentially had no choice but to tell people that it's Peter Lynch who's making the decisions behind the scenes. ARK have done it slightly differently. Cathy Wood is the face of the ARK ETF group, but actually she doesn't oversee all of the investment decisions. So if you look at the ARK Genomics pie, for example, it's there's a separate fund manager who controls the investments for that. Moose has asked a question. Sorry, go on. Yes.
No, I was going to ask why did they tend to hide who the fund managers were back in the days, and to some extent even today? Why do
they get stolen? It's simple as that.
Get poached.
Absolutely. Why wouldn't you? You know, if you can tell Peter Lynch, "Oh, we'll pay you double whatever you're earning," I mean, anyone would do it. It's a no-brainer. Moose says, asked a question: what is the average waiting time before an average investor takes or myself takes the investment out of a specific ETF? That's a very good question, Moose. There's no endpoint that I have for my ETFs like I do for my stocks. I'm in various different ETFs, and some of them are going to be lifelong. So I'm in a Vanguard All World, for example. I'm never going to take my money out of that, and the reason for that is because I see the global economy continuing to grow, and it's going to continue to grow at vast rates. I'm not in a Pacific fund, but that would be something else. I'd probably look to keep that for 10 years if I was in a Pacific fund, simply because I think Asia is going to dominate the economy in the next 10 years, predominantly China and India, although the state of COVID in those countries is probably going to affect the economies there for the next year or two. Something like the S&P 500 ETF, if you looked at it recently, it was probably overbought and overpriced. I could say the same thing about the iShares Global Clean Energy Fund. And those are the types of ones where you can probably realize that they're overbought and overpriced, and therefore get rid of them and just trade them like your stocks, and then rebuy them when the price comes down. The main benefit of doing this with an ETF is that it's much less volatile than your your penny stocks or your small cap stocks. So even if you make a mistake, well, the worst case scenario is you might be down 10-15%, but you can just average in, or you can just leave that be, and hopefully in a year, 2 years time, that 10-15% will have dissipated. We've got a message from Rahul. Thank you for joining me. He's a good friend of mine. Do you think passive investing takes out the element of true price discovery from equity markets? Do you think passive takes out the element of true price discovery from equity market, the ability to look for value? Okay, yeah. Yes and no is the answer to that question. It depends on you as an individual. If you want to sit there and research for 4 or 5 hours a day or a week or whatever it is you want to do, then by all means you will find value and better value in individual stocks. But that's not for everyone. A lot of people work, and we don't all have time to react to the markets. Classic example being a month ago when markets plummeted 5, 6, 7% in a day, and for those people who've got 5 or 6 figure portfolios, that's a big hit to take. But realistically, it's a small dip in the global scheme of things. And it affects those people who have actually only invested a small amount of their portfolio, and suddenly they panic at the 5 and 6%. So it's all dependent on mentality. And again, I would say Benjamin Graham is fantastic at answering that question of how much work do you need to put in for a safe or risky investment. The next question from him is, does this mean that pumping into the index makes a massive bubble? No. So what you're buying when you buy into an index ETF is basically you're buying a piece of all of the companies that form that index. So unless you're talking about needing trillions and trillions of dollars to be able to pump an index, and that's not going to happen. You could do it for certain smaller types of ETFs which have lower liquidity, but for index ETFs, I can virtually guarantee that it's impossible to pump it. Next question was, considering this, what proportion of the portfolio should you aim to hold as a passive or active fund? Again, there's no right answer. So my second slide in the disclaimer suggested that different people will have different investment strategies. There's no right or wrong strategy. If you want to be a value investor, then you may have a higher proportion of your investments in funds. If you're a hyper growth stock investor, then you're probably not going to go for an ETF or fund because you're chasing those high gains, but you're accepting the fact that your risk is you may lose everything. And we've certainly seen in the GWB Discord that people have come to that realization that you can chase gains very quickly, but you can also get the losses very quickly. Some of those people may have benefited by having some proportion of their portfolio in an ETF, but that's a personal choice for people to make. Okay, I'm gonna pause the questions there. Musa, I will carry on your question a little bit later after a few more slides. So I'm going to talk about defensive portfolio next, and this is all Benjamin Graham, literally. And it's interesting because a lot of people say that Benjamin Graham does not advocate higher risk stocks, and it's completely wrong. Those people clearly haven't read his Bible, which is The Intelligent Investor. And on the left-hand side, I've actually delineated what Benjamin Graham says that a defensive portfolio can consist of. And at the top are the lowest risk and easiest management type devices, and at the bottom are the highest risk but highest amount of input and management required for them. We all know about our blue chips. We can talk about FANG, or in the UK we can talk about stocks like Barclays, Shell, BP, and we know about our index funds. And Benjamin Graham says that if no matter who you are, and it's very funny actually, because in one of his chapters he talks specifically about doctors, and he makes a very good point, which is that doctors are educated people, and yet they make a significant amount of mistakes in the market, and the reason is because they think they know it all. And when I started, it was exactly that. I thought I knew better than everyone else, and it's absolutely wrong. There's no way that me, when I'm 20 years old, knows better than people who've been doing this for 50 years. And it was only after I read Intelligent Investor that sunk in. And you have to take your ego out of investing. Facts. And realize that just put your money in blue chips and index funds. You might not make 50% a year, but do you really need to make 50% a year? If you know you're going to make 15% a year consistently, and you can put much more money doing that, then, because you're not going to suddenly have a 40% or 50% loss. He then talks about his defensive companies, which are just below the blue chips, and the examples have come up here with Tesco. Everyone's going to need food. You're never not going to need food in your life. So Tesco's a very safe bet. It's constantly going to outgrow the competition. And we've seen that in the UK. Similar with BT, you're always going to need your communications. You're going to need your internet, your phone lines, and the infrastructure is dominated by BT in the UK. Coca-Cola, it's a brand everyone knows. It dominates the market, along with a couple of other companies. These are the types of companies that are just not going to go away. They've been here for
Tattoo Chef. Sorry.
We've got Tattoo Chef. Next. So Tattoo Chef actually is a perfect enterprising company. Those of you who don't know these, how to delineate all these different companies, by the way, have a read of Intelligent Investor, or there's plenty of resources on the internet that tell you what Benjamin Graham says you need to have in each company for it to fall under this category. And Tattoo Chef is actually a perfect example of an enterprising company. It has outstanding financials. And on top of that, it's got a fantastic growth strategy, but it is still a small cap stock. And I have talked about it being more of a speculative play. It's not a complete speculative play, but compared to something like a Tesco, it's speculative. And that's why it comes under an enterprising company. But I'm a big fan of Tattoo Chef. I know you are. I know Musa is. Wink. So yeah, absolutely agree that you can have this in a defensive portfolio. And then we've got one for XP at the end, which is your net current asset company. And I couldn't think of a better example at the moment than Nano Dimension. Someone posted a week or two back when an MDM reached, I think, just about $6, that the total assets for the company after the recent equity raise basically formed the market cap. And it's still virtually true right now. It's trading 20% above market cap, which is ludicrous. NNDM at these valuations is something that you can include in your defensive portfolio. So when people say Benjamin Graham's investment strategies are boring, it's absolutely false. All of these companies that I've put here can form a defensive portfolio. And
I think it was Noah that mentioned about the net current asset for
that's right,
NNDM. Valid point.
Absolutely, it was a really good post, that one. So some of the principles that I believe, I say some, there's two principles that you need to know about in your defensive portfolio, and that essentially is that first, we shall not lose money. Okay, and why do I say that? Well, if you've got if you've got money sat in your bank account, you're essentially putting it there because you don't want to lose money. But you're losing money because inflation is between 2 to 3%, depending on where you live. So your interest rate is less than your inflation. So actually, you're losing money that's sat in your savings account in your bank by about 2.5% a year or more at this moment in time. Certainly in the UK anyway. I think it would be a similar story in the US. If you're living somewhere like China or India, then it's slightly different. And then after that, once you decide that you will not lose money, then you shall look to make money. And that's a really important principle, because you can take all of your savings, and if you put them in blue chips and index funds, then you're essentially telling yourself that you will not lose money. Okay, and you will not lose as much money as you will by having that money sat in a bank account. And only then are you looking to make money from those things. And we know that Apple has blown away its earnings forecast. We know Facebook has done the same. All of these blue chips and big indexes are continuing to grow, despite a lot of the retail investors complaining that the markets are red at the moment. It's just not the case. We're at all-time highs pretty much throughout the markets. And the second principle to understand is that in your bull market, growth stocks will always do well. And I've talked about market cycles previously in GWB, and I hope that people have looked at those cycles. And I still believe that we're coming towards the end of a bull cycle. I've made my predictions before, saying it could be Q4 2021 or it could be the first half of 2022, and I stick by that. I don't think I've changed my mind about any of that at the moment. And we've also seen recently that even in slight bear markets or in corrections, that value stocks continue to do well. And if you find your value stocks, you'll still be making good money at those times. Let's go back to some of these questions. We've got, I need to scroll up here. So Musa asked, are ETFs and indexes dependent on market rotations as well? Absolutely, yes. You will always have ETFs. For example, in green energy, we saw a massive hype up when Biden got elected, and it's all since come back down to best valuations. Index funds are the same. You know, when you're in a bear market, your index fund or index tracker is going to go down. These are the principles where you need to apply your averaging and your systematic purchases, and you'll just build up wealth over time if you continue to do that. You know, so for example, I put in £800 a month from my salary straight into my ETF. It doesn't matter if it's on a peak, if it's on a low. If you just keep doing that and you ignore ups and downs, then you just accrue, and over time, those ETFs go up because they, you know, you've hopefully made the right choices with those ETFs, and that's why I've got the portfolio size that I have at the moment. As a long-term investor, how often do you track the progress of your ETF investments? That's a very good question, Suleiman. So there are a couple of funds that I track weekly. I'll have a brief look at the price because it's part of my watch list every day, but it doesn't matter what the price does, whether it's up or down. But I'll have a proper look at whether there's been any significant changes to those ETFs weekly. My much longer term ETFs, I only really look at on a monthly or quarterly basis. And that's just to make sure that you know, nothing has gone completely wrong with those ETFs. Especially my Vanguard All World one, you know, that's a 25-year investment. It doesn't matter what happens right now. It's been a 5-year game so far. There's still 20 years left in that one. So, yeah, it doesn't matter. Maybe even annually, I can look at that one if I wanted to. Earl has asked, you solely invest in ETFs? No, I don't. I invest in growth stocks. I invest in property. I have investments in bonds. I have a very varied portfolio. But ETFs form a majority of my equity portfolio. And this slide shows you why, because I have a very defensive minded portfolio. It's done well. XP is picking up NNDM. Thank you very much, XP. You brought that to my attention. We love you for that. Teddy is saying shilling for your tattoo chef. It's true. It's true. We all love it. I want to know who's bought those trolleys full of tattoo chef goods, because, you know, if I could, I would as well.
These shareholders in Jeremy for Financial Education in his Discord, like they're constantly raiding targets in America. Just anything there, they just fill the trolley. So I know
that's what we need in the UK. We're going to do the same. We're going to do the same. What else do we have here? Did someone say inflation? I did say inflation. Absolutely. Teddy wants to go internally on a rant about that. Fair enough. Moose is having a little laugh about some guy I told to educate myself. Yeah. He's since left. Earl, would you use an ETF as a vehicle to hold cash for investing in dips? Absolutely, Earl. I think that's a really important point. Yes, is the short answer to that question. And you want to put it in an ETF, which is safe as houses for that. The other retail investment option for that is a REIT. I'm not going to be talking about REITs today. I think probably Manny's even better to talk about REITs in a future video. But I think these are two things instead of having cash that will just benefit you, because even if it's 2, 3, 4% over a bank account, you know, it adds up very quickly if your savings account has got any amount of money in it at all. Musa has asked, from a technical aspect, can you use indicators on it? Absolutely, Musa. Yeah, you can. So for index funds, essentially what you want to do is use your technicals on the S&P 500 or whatever it is you are tracking. And you've made some excellent videos about technicals previously, so I won't go into that. But essentially, I use a weekly chart for the technicals of my indices, and then I'll dive down into a daily chart thereafter. But the weekly chart is really good for your long term prospects. A lot of you have told that I follow David Paul, who's an excellent swing trader, and has some fantastic knowledge about technical analysis, especially for the indices. So go check David Paul out if you guys want a bit more information about that. Yeah, Suleiman's got an excellent idea for you there, Manny, about property investing. I think I'd be very keen to hear your views on that as well.
Just made a note. Yeah, it's a great question. Yeah.
Need to get a new YouTube account. Yeah, Demi, we've got you. Okay, so let's move on then. So we're going to talk about accumulation versus distribution. Virtually all ETFs will have options for accumulation versus distribution. It's very simple. Your accumulation funds will pay dividends back into the fund, so you will accrue more of your ETF or your mutual fund because your dividends automatically rebuy more of those companies that are in the fund. The benefit of this is that you get compound growth over a period of time. Now, you may only get a half or 1% overall dividend yield from an ETF, unless it's a specific dividend ETF that you've gone for. But those 1% over 20 years add up, because it doesn't count as 20%. When you compound it up, it will be something like 33% extra on top of your capital gains that you've already got from that ETF. Distributed funds just pay out your dividends to your account instead, and different ETFs will pay them out at different times. So you can have quarterly, annually. There are actually some ETFs that pay a weekly dividend out as well. The benefit of this is, if you are needing an income, so if you're furloughed or if you're retired and you rely on some sort of income, even if it's a small amount, to get you through your week or your month, then these are fantastic, because if you have managed to accrue by the time you retire, which could be 65 for a lot of us, £1 million, let's say, then even if you get 1% dividend on that, then that's a significant amount of money that you're getting back. So that's £10,000, income, which will be tax free at that point as well. So yeah, different strategies for different people again. So we're going to talk about some top performing ETFs. Now, I've written here it's UK investable, and the reason for that is because it's very difficult for me to show all the US investments out there, simply because I don't have access to them. So I'm going to click this to take you through, and this is a fantastic website called Just ETF. I've set my preferences here to English, but you can change your location, and people in Europe will be, so people in Europe will be happy. It doesn't accept everywhere, so sorry, Moose. I know Denmark's not here, but it should be good for most people. I do have something else for you, Moose, and the US investors as well. So I've just arranged this by all ETFs globally, which are available for investment in the UK. And that's why you will not see ARK Invest in any of these lists here. And what I've gone for is we've gone for a 1-year percentage gain, just to see what's performing really well in the past year. And I mentioned Rhodium ETF previously, which is up thousands of percent over multiple years. But you can see just in 1 year, it's up nearly 250%, which is a fantastic. It's just amazing. And for those of you, a bonus tip is rhodium is still at all-time high prices. Palladium is at really good prices right now. Platinum isn't quite at all-time highs, but it's doing really well. So look for your platinum group metal companies. I've been pushing Sylvania Platinum in GWB. Have a look at that. I'm a big fan. Another one, so a lot of people are complaining about the iShares Global Clean Energy ETF because it's taken a nosedive recently. But if you look, it's actually up 100%. Let's go back there. So it's up 100%, that one here, in the past year. You know, not something that you can laugh at there. It's really good gains. We've got LNG battery value chain. That's really looking at the basic materials and commodities which are involved in the battery value chain. So you've got your ETFs for that. I talked about UCITS earlier. I'm going to just quickly go back to the PowerPoint and mention this again. So I've got my top picks here, and we will send these slides out, guys. So if you want to check your top performing ETFs, you will be able to click through and have a look at them yourself. So someone asked me recently, what is UCITS? It's the same website here, and it will just tell you what UCITS is. And it's essentially it's a tick mark. So it's a validity measure in the European Union that will basically say that this is a safe ETF or fund to invest in. It's really important. You don't have to invest in a UCITS certified ETF, but if you do, you know that it's going to be high quality, and the people running that fund are going to be doing all the right things for you. So it's just something good to mention there. Let's see what other people have said. So Moose was asking again, if you're invested in an ETF containing several stocks, who usually pay dividends? Is the total dividend the sum of them all, or does the ETF get a percentage of that too? Nope. So Moose, the way they'll calculate it is they'll take a total, they'll take the total dividends that have been paid or accrued over that period of time, and they will equally distribute it per share of the ETF. So if you've got one share of your ETF, you'll get 1 divided by however many total shares there are. Another benefit is obviously with your ETFs, you can buy partial shares in most funds. The stocks in Denmark are pants. Well, you say that, but I'm not so sure about that actually. Well, seeing as you mentioned Denmark, we'll go straight to the iShares Global Clean Energy fund. So let's dig a little bit deeper. So where we've got iShares. So we've got iShares. So once you can Google a ETF once you found it. So if you've gone on to your ETF screener and you like a particular ETF, and you think, okay, let's have a look at it in a bit more detail. So this website will give you some information. It's very basic in terms of what you get from it. So you get your percentage gains over periods of time. And there's some heat maps there for you to look at. But really, the most important information that you will find is on websites themselves. So if we look here at the iShares Global Clean Energy UCITS ETF, now anything that is UCITS certified, if it's a UCITS 3, 4, 5, etc., they will have a KIID, which is a key investor information document. They will also have a prospectus and a fact sheet, and you'll see most ETFs with these really key documents that you want to have a look at. And we'll have a look at that in a second. The ETF will describe what the ETF is about, what the objective is. It will give you all your disclaimers about investment risk, etc. You'll get your return performances for the past, and then you'll get your past performance does not equal future performance stuff. Yeah. You get all your legal information that they need to provide for your ETF as well. So, you can have a look at all of this, but really the important information that you're going to get are in the fact sheets and the key investor information documents. If we have a look at the key investor information document here, so it's usually a 2 or 3 page summary, and it will give you the main objectives of the ETF and what it is tracking. they have to give you a mandatory risk and reward profile. So this particular ETF is a risk profile of 6 out of 7, which suggests that it's a higher profile, higher risk profile. And then if you go down, they will tell you what charges are and your performance over the last normally 5 to 10 years that they'll give you, but not all ETFs have obviously been around for that long, so they may give you performance for a bit shorter. So that's a really good summary of an ETF. So I always recommend that if you're going to go for it, then look for the KID or the Key Investor Information document. The other thing to look at is the fact sheet, and this will tell you things like changes in your ETF portfolio. So what has happened in this ETF in the latest fact sheet. So if you want to keep track of what's going on, then this is a document for you. And it will tell you things like what sectors that your ETF is holding. And surprisingly, for a clean energy fund, energy forms only 2% of the fund for this one. Which is quite something. And you get your top 10 holdings in most fact sheets as well. If you want to know all the holdings, then normally you can go down into your information and holdings. Here we go, and you can click through on all of your holdings. And Musa, the reason I was mentioning this is because Vestas Wind Systems is one of my favorite companies. It's a Danish company. They make wind turbines globally. Absolutely love them. Unfortunately, I was never able to get into them as a stock, but I do own them through my funds. I think they're going to dominate in the future. Some other interesting companies here. I think XP might recognize some of these. You got Enphase, you got Excel, Nextera, Solar Edge is a fantastic company. Plug Power we've talked about previously.
SSE.
Yeah, exactly. So this one ETF has so many good companies in them. And you get exposure to all of these companies. So it doesn't matter if one company does badly, because the other holdings will hopefully keep the ETF going. And that's the benefit for me. If I don't want to risk Vestas Wind Systems because tomorrow there might be a problem in their company, well, I can buy shares in this ETF instead, and the volatility won't be as high. Let's have a look at questions. Teddy's saying Moose about to find out all the Danish shares are where the real money is at. So there are some good Danish shares. I'm sure Moose knows about them. I'm not saying that there's hundreds, but the odd Danish company is definitely piqued my interest. Someone saying slides are immaculate. Yep, you'll get access to all of these slides, guys. Well, yes, Bacchino, yeah, absolutely. It's more. I like a balanced argument about everything. I don't get overhyped, but I also certainly don't believe on the big bear that some people think I can in the Discord.
You're the Tesla bear.
Well, I love Tesla, guys. I absolutely love Tesla. Big fan. But if I was running the company, I'd be doing it differently. I think I'd make shareholders a hell of a lot more money. I don't have the Elon Musk effect. That's the only thing. But
the Doge farmer, yeah.
Yeah, I can't pump Bitcoin and Dogecoin, but I can at least run the company slightly better, in my opinion. The Danish shares are drier than Jerome Powell's speech. Yeah, that's true. Not really concerning. Yeah, it's true. Demi's coming up with some blinders here. Would you consider minimum risk SPACs better or worse than an ETF? Both got money with minimum risk. Moose, that's a very good question. The problem with a SPAC is you're only guaranteed your $10 investment up to the point of merger. After the merger, anything can happen. So it could half. If investors don't like it, you could still lose 50% of your investment. So it's only up to that point that you're safe with your SPAC. With your ETF, with your Vanguard All World, which we're going to have a look at next, for example, this is not going to drop 50%. I can virtually. COVID made it drop, I think, 35% in the space of a month and a half, and then it shot up 50%. Well, it shot up more than that. It shot up about 65% to overtake the COVID dip and pre-COVID levels within a year. So for me, I'd go for an ETF all day, because the volatility is just not there, and that there's 3,500 stocks here in this particular ETF. So it doesn't matter if 100, 200, 500 stocks do badly. The global economy, in my opinion, is going to continue to do strong. And even then, with 3,500 stocks, look at the risk profile that investment managers have to tell their clients about. It's a 5 out of 7. Right. So, you guys are talking about risk profiles that aren't even technically on the scale when we talk about stocks like, and I've done it as well. So, I'll be the first to admit that I've also thrown loose change for me into stocks that have plummeted. And that's the gamble you do. But the vast majority of my money is safe, and it doesn't matter if I lose the 500 or 600 pounds that I throw trying to chase a quick bit of cash. This is giving some excellent Scandinavian stocks out there. Fantastic. You should stick those in the GWB chat. I'll have a look at those at some point. I've not heard of those actually. So thank you for those. I'm going to pray now. I don't know if I'll be back, but okay. Yeah, Suleiman, thank you for joining us. We are nearly done anyway. So I just thought I'd show a couple of my other favorites. So I'll go back to the last slide here, just so people can see. So we'll just quickly talk about these. So Vanguard FTSE All World, you all know I'm invested in this. This is basically my bank account. So if I need money, then it's very accessible to sell. But if I don't, it just keeps accumulating. And I have a monthly proportion of my salary that goes into this, which I've increased. If I can save 20, 30 pounds a week, that's an extra 120, 150 pounds that I can put into the ETF per month. And we all know about compound growth. And the benefits of that over a long period of time. Bailey Gifford American is a mutual fund, so it's not directly an ETF, but it is fantastic. I'm a big fan of this one. I think I've got it open somewhere. Yep, here we go. So this is the Bailey Gifford American Fund. Bailey Gifford has been ranked in the top 5 investment management firms in the world recently. Their management are world class. They're based in Edinburgh. And they have some really, really fantastic investment funds. My favorite is the American fund, and it's closely followed by their Pacific fund, which I've also mentioned here at the bottom. And you can just see the growth here. It's ridiculous. You've got the 5-year growth at the bottom. It is absolutely monstrous. If you want to have a look at their holdings at the moment, so this actually recently changed. Tesla used to be up there at the top after its massive gain, but they've had to sell off a proportion of that to remain UCITS compliant. We've heard of all of these companies, or at least most of them. I'm sure you've all heard of. And this is an actively managed fund. So we've got the choice of an accumulative fund or an income fund, which is the same as a distributor fund here. And you can see that in their key information, they say that they want to beat the S&P 500 index by 1.5% every single year. You can see that they pay their dividends out just once a year. You can see that their pricing is only once daily as well. And the ex-dividend date is the last day of April each year as well. I was going to try and find it'll be here somewhere. I won't waste too much time, but yeah. So you can find out what the fees are for Baillie Gifford. They're an actively managed fund, so they will be slightly higher. Same thing with their Pacific fund. I'm a huge fan of this. I don't know if I can find. That's on Harvard's Lansdowne. We want the actual Baillie Gifford website. You'll see the growth in this is, I think, 380%. In the past 5 years. Yeah, it's there you go, 300 and something percent, 320% in the last 5 years. It's massive. And I'm a big believer in Asian funds, and Asian companies, especially Pacific companies at the moment are very strong. And here are some of the holdings. Samsung has just blown away its earnings as well recently. We've got Tencent, which has been doing phenomenally. We've got TSMC, big believer in semiconductors, and TSMC is the biggest of them all. JD.com. I've got some small amounts of shares in JD. Bigger believer in Alibaba. But yeah, you can just see that that these companies are doing really well. You can see a breakdown of the geographical areas as well, where this fund is. So lots of useful information on the websites, guys. You can really dig as much as you want. You can see here that they want to outperform the MSCI Asia X Japan Index by at least 2% per year over every 5-year period. Something else I've written here is my favorite S&P 500 is by far the Vanguard S&P 500 UCITS. It's got the lowest fees. It's got massive amounts of liquidity. It is insane. This fund has got tens and tens of billions in free liquidity in cash. So you should never have a problem buying and selling it. We've talked about the global clean energy. This is a lesser known one. It's Liontrust UK smaller company. So it invests in AIM. I think you guys, a lot of you saw my recent presentation for my top 5 AIM stocks that I think will do well in 2021 and beyond. And this is the Liontrust, which you can buy shares in yourself. Actually, Liontrust shares doing quite well at the moment. And this is an excellent fund, really good management team. Again, if you look into them, once again, you'll find all your investment literature. So these are legal requirements, guys, for your ETFs. They will have to have the fact sheets and the KIDs in order to be compliant. And that's the reason why you don't have your ARC ETFs in the UK, because they're just not compliant with the rules. Whether they do that or not, well, that's not up to me. But I told you that for ARC fans, I do have a little bit of good news. So this is a fantastic article published only recently, a week ago, which I was going through. The link to which I'll actually post in the GWB Discord if you guys want. And there are some fantastic alternatives to the ARC ETFs, which will be mentioned in here. Some of these I'm a big fan of. So the iShares Automatic and Robotics UCITS ETF is something I'm looking at closely. There's also a iShares semiconductors one, which I've been looking at closely because I need to somehow consolidate all my semiconductor holdings. I just hold way too many bitty pieces in them. So I might sell all of those and just put them in an ETF. And that's the benefit, I don't have to worry about micromanagement of my funds doing that. So yeah, that's your just over an hour, so I've been a little bit slow, but hopefully I've cleared a lot of things about ETFs. I'll take the final questions. So we need to scroll up a little bit here. Here we go. I've got Musa QU, the Indian small cap aimed being India's biggest watch channel for youngers. Recently made it. Yeah, QU is, I think you mentioned them to me a little while ago. I did do some research into them. Really interesting company. And based on what's happening recently, I think they've got a really good potential to grow. I'm a big I'm a big fan. I'm still doing a little bit of research into them at the moment, things like management and where they're heading. What else have we got? When looking at an ETF, do you look at all their holdings as well, or do you choose depending on the focus market sector, ETF founder, etc.? Yeah, if I tried to look at all their holdings, I'd be there all day, and still probably wouldn't get through them.
Yeah.
What I look at is their top 10 holdings, generally speaking, Musa, because the top 10 holdings generally will form 60 to 80% of the portfolio in most cases. And if I like their top 10 holdings, then I won't look at the rest of them. Focus market sectors, I'm not personally in many at the moment. So I mentioned a couple like the semiconductor and the robotics ones that I do want to get into. They are more important for me to look at what companies are being involved in. We all know that ARK made a recent ETF, and there was some really questionable choice of stocks included in it. Yeah. And it's things like that would put me off some of the more focused market sectors. I do like ARK's ARK G pile for genomics ETF, but I'll leave that for another time. Apologies if I'm speaking too fast, Musa. I need my own GWB channel. No, I don't think so, Random. I'm always around. I'm more than happy for you to tag me, and I will provide as much information as I can. Demi, you're very welcome. Rahul, thank you. Next, thank you very much. Bav's going to be doing some research into ETFs. Excellent, good. If you need any help or if you've got any questions, be sure to ask. Yeah, Musa, absolutely. And you just small steps. I don't think I'm here to convince anyone to move all of their money into ETFs. Certainly not. But I think I've shown you some of the benefits that you can have by investing in them. Random Things has asked if you had 10K to start off at this point in time and wanted to build a defensive portfolio, how and over what period would you deploy that capital? That's a very, very good question, Random Things. I would not do something crazy. I do what Emmanuel has preached throughout his server for since time began, essentially. And I know a lot of people use different investment strategies. Dan does something similar, which is put a small portion, or maybe 50% of the initial amount of money into what you want to invest in. If that's an ETF, then great. Put 50% of that into your ETF and use the rest to make monthly or weekly installments, however you want to do it. Like I've told you, I put in monthly amounts into my ETF and then just forget about it. And if I need the money, I don't go to my bank, although I do have enough just for emergencies in there. I have most of it in the ETF. And 10K will do you absolute wonders. If you make 15% compound on that, you'll very, very quickly reach six figures. When I say very, very quickly, we're talking relative terms. I'm not saying within a year, but you'll be surprised. You'll be surprised if you keep putting, let's say, £600 a month after your 5K investment. Over 5 or 6 years, you'll be very surprised at how much money you've got in there. I think you would. No problem. Oh, you're Northern Monkey. Excellent. Thank you very much for listening. I hope you guys all learned something. Thank you for attending. I know there's lots going on, I'll hand it over back to Emmanuel. Thank you for the opportunity to do this.
Bro, that was fantastic. That was phenomenal. I mean, for me, I am currently sitting very heavy in cash. And, for me, it's really irritating seeing the cash in my bank, just sat there, not doing work. And, I wanted to get more knowledge, and I think a lot of our members as well wanted to get more knowledge about ETFs as a potential option, because SPACs is probably it's an option as well, especially those that are trading below $10 or at $10. But like you said, the risk, we saw it with STEM today. The merger completed, and I think it drops like 7-8%, like by within half an hour. Eventually it recovered over that day, but that could be terrifying. If you've used that as your to put all your cash in, then that could be very terrifying. So, I mean, with ETFs, you've given us great insights, even pretty much equipped us with what we need to go and do our own research, and honestly, truly valuable, bro. And thank you so much. Thank you so much.
No problem. You're very welcome.
Yeah, I hope you guys gained some value, GWB elite members. We can see all of them are definitely gained a lot of value, and I think people will come back and watch this. And again, I'm going to rewatch it myself, because there are a lot of gems. I felt what Musta said when he said sometimes you were saying stuff that my brain is still trying to compute.
Yeah, feel free to ask questions, guys. I'm always around in the Discord, so let me know.
Okay, cool. So I think that's it, guys. So elite members, thank you so much for joining. And Kay's always around. We appreciate you, brother. Appreciate all your contribution. And I look forward. I think we will do this property thing. It's property one. A lot of people have asked me about that. And you mentioned REITs as well. REITs is something that I do have a nice chunk in. And it's compounding. It's just compounding away. I haven't really looked at it in a while. But thank you so much, everyone. And we'll catch you in the next one. Peace. All right.